Okay, listen. I want you to hear me on this one because this is a big one. I recorded this at my desk. It's late at night here in Palm Desert, and I'm going to walk you through something I've been tracking for about 3 years now that's finally showing up on the front pages. And the reason it matters is it's not theory anymore. The numbers are showing up. The defaults are showing up. The gated funds are showing up. And the central banks, the people who print the money and try to keep the system from blowing up, they are quietly, and not so quietly, sounding alarms. Here's what to know. Last week, the FT reported that Blue Owl Capital, which runs a $36 billion private credit fund aimed at wealthy investors, permanently halted redemptions. Investors wanted to pull 22% of the money out. 22%. They couldn't get it. The fund said no. That's not a glitch. That's a structural failure inside a corner of the system a lot of you, frankly, have never even heard of. And that fund is just one fund. Stay with me here, because the same week, the Wall Street Journal reported investors tried to pull $5.4 billion out of two Blue Owl private credit funds. And BlackRock, the biggest asset manager on the planet, capped redemptions on its $26 billion private credit fund. Capped them. Capped. That means even the giants can't honor the money requests anymore. That's a big deal. Now, normally, you might say, well, Matt, that's just one or two funds having a rough quarter. Every market has rough quarters. It's fine. Central banks have tools. The Federal Reserve can fix this. But it's not. Because what we're looking at right now is not a quarter. It's the early break of a plumbing problem inside a $2 trillion market that almost no retail investor can see into. And the central banks have been warning about this for years. The Bank for International Settlements, which is basically the central bank of central banks, the Fed, the IMF, the Financial Stability Board, they have all in the last 8 months raised alarm bells. And yesterday, Reuters reported Fed Governor Lisa Cook specifically said private credit is now a vulnerability she's monitoring closely. That's not a casual comment. That's a governor talking. So here's the thing. The question is no longer, will private credit have a problem? The question is, how big does the problem get, and how does it spill into your bank account, your 401k, your pension, your small business line of credit? From my perspective, we're entering a period where this matters. Let me walk you through this carefully. Okay, so let me strip down what I'm talking about. I'm going to use plain English. No jargon, so private credit. What does that mean? It means lending money to companies that don't want to borrow from a regular bank. Banks have a lot of rules. Banks have regulators breathing down their neck. Banks have capital requirements, which is basically the amount of real money they have to keep on hand for every loan they make. So companies, especially medium-sized companies, sometimes say, forget it, I'll borrow from someone else. And those someone else's are called private credit funds. A private credit fund. That's basically a giant pile of money, usually raised from wealthy individuals, pensions, endowments, insurance companies. The fund then lends that money out to companies that need it. They charge interest. They make money on the spread. Think of it like a bank, but without the FDIC insurance, without the public reporting rules, and without the regulator sitting in the room. The biggest names in this space right now are Blackstone, BlackRock, Apollo, Ares, KKR, and Blue Owl. Between them, they're sitting on trillions of dollars of loans. Now, why does this matter to today's story? because over the last 5 years, this market exploded. Bloomberg reported that at the start of 2025, the private credit market was around $3 trillion. CNBC is now projecting it grows to $4.9 trillion by 2029. Reuters says Morgan Stanley's estimate is $5 trillion by 2029. The growth is staggering. Nobody is watching it because it's not a stock you can easily buy. It's a private deal between a fund and a company. Most of you can't access it directly, but a lot of you are exposed to it through your retirement accounts, through insurance products, and through the banks that lend money to these funds. Let me give you one specific partner, one specific backer, to make this less abstract. Athene Holding, which is the retirement annuity arm of Apollo Global Management, has over $300 billion in assets, and a big chunk of that is private credit investments. So when annuity policyholders cash out, they are, in effect, relying on the private credit market to perform. That's just one example. There are hundreds of these interconnections now. The Financial Stability Board, in a report released in May of 2026, literally warned that interconnections between private credit funds and banks and insurers and private equity firms are deepening, and that's making the system more vulnerable. That's not me. That's the FSB. Okay, by the way, hey, before I go further, go ahead and hit subscribe for me right now, and make sure you're signed up to the Ox Talks newsletter in the link in the description below. I'm dropping a new piece this afternoon. It's called the Private Credit Domino Map. It's a one-page PDF breakdown of the 7 specific institutions I think could be the next to blink. And that goes only to the newsletter people first. So if you want it, sign up now. You'll get it this afternoon, before tomorrow's video even goes up. Okay, back to the story. So, here's why this matters to you, not just to them. We have been told for years that private credit is the safe alternative to banks. Wall Street pitches it that way. Higher yields, better protection, secured loans, direct deals. And you know what? In many cases, it's true. These loans are usually senior secured. They sit at the top of the capital stack. If a company goes bankrupt, private credit lenders are supposed to get paid first. But here's the bigger problem now. The composition of these loans has changed dramatically. The Bank for International Settlements, in their March 2026 quarterly review, put out a paper called Private Credit Software Lending Meets AI Disruption. And here's what they found. Outstanding loans to SaaS companies. SaaS, that's software as a service. Basically a company that sells you a subscription to use their software over the internet. Outstanding loans to those companies went from almost $8 billion in 2015 to over $500 billion by the end of 2025. That's $500 billion. 19% of all direct private credit loans are now sitting in software companies. Let that soak in. 1 out of every $5 in private credit is loaned to a software firm. Why is that a problem? Because software is being disrupted by AI right now, in real time. And I mean this is not theoretical. Software stocks are down 30% over the last 5 months. UBS ran a stress scenario and estimated that under a serious AI disruption scenario, default rates on private credit could climb to 13%. Currently, the long-term default rate is around 3.5%, so from 3.5% to 13%. That's nearly 4 times worse. BlackRock's own commentary, which I have a link to in the description, basically says defaults among non-investment grade loans are running higher than usual. BlackRock, not a critic, the world's biggest asset manager. Okay, so here's the loaded question. If the AI disruption to software is so real that software stocks have already dropped 30%, and if 1 out of every 5 private credit dollars is loaned to software companies, then why are the people running these funds still telling investors everything is fine? Why are Blackstone and BlackRock still publishing commentary saying losses are manageable? Hmm. Think about that for a second. Stay with me here. Okay, here's the timeline. Let me walk you through how we got to this point. I'm going to take you beat by beat, each one bigger than the last. Back in 2020, the pandemic hits. The Federal Reserve drops interest rates to zero. They print trillions of dollars. Money floods the system. Banks tighten up because they don't know what's coming. Private credit funds step in and they lend. A lot. That was the moment the machine kicked into high gear. Then 2022. Interest rates go from 0 to over 5% in about 18 months. That was a huge shock. A lot of zombie companies that borrowed at 2% suddenly have to refinance at 7%. Private credit funds do okay because their loans are floating rate. Their income actually goes up. Wall Street loves it. Money pours in. Then 2023 and 2024. Private credit becomes the hottest asset class in finance. Blackstone goes on TV. Apollo goes on TV. CNBC runs segments every week. Pension funds pile in. Insurance companies pile in. Endowments pile in. The Wall Street Journal reports that private credit fundraising hit record levels, over $300 billion raised in 2024 alone. Then October 2025. A string of high-profile private credit-backed companies collapse. The Instagram finance community starts running numbers showing SaaS stocks fell over 30%. Defaults are up 78%. Blue Owl permanently gates a $1.6 billion fund. This is the headline event. Investors cannot get their money out. This is the first time a major fund has done a permanent gate, not a temporary pause, but a permanent one. And now, yesterday, and over the past week, we have BlackRock capping redemptions on a $26 billion fund. Blue Owl facing $5.4 billion in withdrawal requests. The Financial Stability Board issuing a formal warning on vulnerabilities. Reuters reporting on Lisa Cook's speech, where she flagged private credit as a key vulnerability to monitor. The Boston Fed publishing a paper saying that bank lending to private credit has tripled since 2017, and that this is the channel through which a private credit shock would spread to the broader banking system. The IMF's October 2025 Global Financial Stability Report flagged rapid expansion of private credit markets as warranting continued monitoring. Okay, from my perspective, this is the worst one. This is the moment where central banks have stopped using careful language and they have started using the words vulnerability, monitoring, systemic risk. Those are specific words. Those are not the words of a calm regulator. Those are the words of a regulator who is preparing for a possible shock. And here's where this stops being about a few hedge funds and starts being about your life. Let me break this down. First layer, the banks. The Boston Fed paper published in 2025 said that bank lending to private credit funds has roughly tripled since 2017. That's bank balance sheets now exposed. Citi, JP Morgan, BofA, Goldman, they all have exposure. Not huge, but enough that a serious shock in private credit would force them to mark down loans, tighten up new lending, and stop making new loans to small businesses. That means your business line of credit gets harder to get. That means small business lending freezes. Second layer, the pensions and retirement accounts. The largest pension funds in the United States, including state pensions, have allocated money to private credit over the last 5 years. The California Public Employees Retirement System, CalPERS, teachers' pension funds, they have private credit allocations. If private credit funds start losing money and gating redemptions, those pension funds take a hit. And pension funds don't have a cushion. They have retirees expecting checks. Third layer, insurers. The Financial Stability Board report specifically flagged insurers as a vulnerable transmission channel. Annuity products, life insurance products. They are heavily invested in private credit because the higher yield helps them meet their obligations. If private credit defaults spike, insurer balance sheets get stressed. Regulators then have to step in. Fourth layer, the 401k exposure. Most retail investors don't directly own private credit, but your 401k might include target date funds, balanced funds, alternative investment funds offered through your plan. Many of those have private credit sleeves. If those funds start marking down, your retirement account takes a hit, quietly, without you ever hearing about it. The truth is, this kind of thing takes time to fully surface. From my perspective, we are not at the 2008 moment yet. We are at the 2007 moment when the warnings were starting to land and most people were still going about their day. The question is, what comes next? Okay, here's where this gets really important. Let me walk you through the next layer, which is the central banks themselves. Why are central banks preparing? What does preparing even look like? Well, number one, the Federal Reserve has changed the language it uses. The Fed's Financial Stability Report from November 2025 specifically mentioned private credit as something they're watching. They're tracking the interconnections. They're analyzing the spillover channels. That's preparation. The Fed is preparing by gathering data so it can react fast. Number two, the Bank for International Settlements, the BIS, the Central Bank of Central Banks, headquartered in Basel, Switzerland, has been publishing paper after paper warning about the buildup of non-bank lending and the interconnections. Their March 2026 paper is essentially a warning. They're preparing by pressuring national regulators to get ahead of this. Number three, the Financial Stability Board, which is the body that coordinates financial regulation across the G20, in May of 2026, released a dedicated report on vulnerabilities in private credit. That report concluded that the fast growth, the interconnections, the lack of transparency, the use of leverage inside private credit funds themselves, all of that combined is a structural risk. They're preparing by sounding the alarm. Number four, the IMF, in its October 2025 Global Financial Stability Report, called the rapid expansion of private credit a vulnerability. And they specifically mentioned stablecoins, but that's a story for another day. The IMF is preparing by telling every finance minister in the world that this is something to watch. So when you put that all together, the FSB, the BIS, the IMF, the Fed, all of them in the same 8-month window, raising the same warning, that is not coincidence. That is coordination. Okay, so what's the domino path? Here's what to watch from my perspective. These are the things I'm watching, in plain English, no jargon. Number 1. More permanently gated funds. If you see another major fund freeze redemptions permanently, that means the money coming back from borrowers is insufficient. That's the canary in the coal mine. Number 2. More insider selling from executives at BDCs. BDCs are business development. NT companies, they're publicly traded versions of private credit funds. If the executives who run them start dumping their own stock, that tells you they know something is coming. Watch the Form 4 filings. They're public. Number 3. Rising defaults in the underlying loans. Fitch reported U.S. private credit defaults at 5.2% in October 2025. That's already elevated. Watch that number. If it climbs above 7%, we're in trouble. If it climbs above 10%, we're in serious trouble. Number 4. Falling software and SaaS stock prices. The 30% drop we already saw has hurt. If it drops another 20%, the loans against those companies will start to struggle. Watch the IGV ETF, which tracks software. Number 5. Bank earnings calls mentioning private credit exposure. The big banks report quarterly. If JP Morgan or Citi starts warning about private credit exposure in their earnings calls, that means the bank regulators are worried and the banks are about to pull back. Number 6. Continued gated redemptions and elevated withdrawal requests at the big funds. Blue Owl hit 22% withdrawal request. If another major fund hits similar numbers, that is a signal. Okay, so what does all of this mean? It means we're entering a period of financial plumbing stress. Whether or not this turns into a full-blown crisis depends on a few things. It depends on whether software defaults accelerate. It depends on whether AI disruption accelerates. It depends on whether the central banks react too late or in time. From my perspective, I think it's more likely than not that we see at least one more major fund gate redemptions or fail outright. What does this mean? It means the interconnections mean that the impact will spread beyond private credit itself. Now, I told you this was coming. I've been talking about the interconnections and the growth of private credit for over a year on this channel. The numbers have arrived. The warnings are arriving from the official sector, and the first cracks are showing up. The question now becomes, who's next? Which fund gates next? Which pension fund takes the hit? Which bank has to mark down exposure? That's the cliffhanger. That's what I'm tracking every single day. And here's why this matters to you, not just to them. If you have money in a 401k, in an annuity, in an insurance product, in a pension, in a small business that relies on credit, this affects you, not someday. Now, from my perspective, the smart move is to be aware of where your money is. If you're in target date funds with private credit sleeves, that's fine, but know it. If you're directly invested in BDCs through your brokerage account, check the exposure. If you own individual software stocks, watch the leverage on their balance sheets. I'm not telling you to sell. I'm telling you to be aware. Stay with me here. Let me walk you through what I'm doing about it. I'm a practicing California attorney. I'm not a broker. I'm not a financial advisor. I'm a risk mapper. And what I do is I map where the bodies are buried before the shovels come out. That's the job. That's the channel. Okay, by the way, hey, go ahead and hit subscribe for me right now. And if you haven't already, make sure you're signed up to the Ox Talks newsletter in the link below. The private credit domino map drops to subscribers first. It's a one-page PDF that names the 7 institutions I'm watching with their dollar exposure to private credit and the specific signal I'm waiting on from each. Free, no spam, just substance. Okay, back to the close. Okay, let me give you the forward-looking promise. Here's what I'll be watching this week. Tomorrow's video will be on a related angle. We're going to walk through what a Federal Reserve response could look like. There are specific tools at their disposal. We're going to walk through what each one does and why each one matters. Tomorrow, same time, the next piece drops. Subscribe and turn on the bell. Okay, final thoughts. Listen, I've been doing this for 30 years. I lived through 2008. I had clients go bankrupt. I had clients lose their homes. I had clients lose their businesses. I had clients lose their marriages because of money stress. That is real. It's not abstract. So when I say the warnings are landing now, when I say the canary is chirping, I'm saying it because I've seen this movie before. And this movie has a pattern. The pattern is that retail investors are the last ones to find out. The pattern is that the warnings arrive early and they're ignored. The pattern is that by the time the public knows, the damage is already done in the institutional layer. From my perspective, the smart move is to be the person who knows early. Not because you want to panic, because you want to make calm decisions when the wind picks up. Okay, the question now becomes, what happens when the next fund gates? What happens when bank earnings calls start mentioning private credit in the risk section? What happens when EBIS issues a formal warning, not just a paper, but a formal warning? We're getting closer. Stay subscribed. Okay, end of video. Let me give you the disclaimer. These are my views and opinions. This is informational and entertainment only. It is not legal, financial, or investment advice. Always consult your own professional for your own situation. Everything I shared here today is based on publicly available information I believe to be accurate as of the publishing of this video. If you guys enjoyed the content today, leave me a like. Subscribe to the channel if you haven't already. Go consider signing up for the Ox Talks newsletter, links in the description below. Leave me your thoughts and comments. I read every single one. With that being said, I will talk to all of you soon. Thanks. Bye.